Welcome, students of business and law. Today we'll break down key concepts from the Companies Act, 2013, the backbone of how Indian companies are formed, managed, and dissolved. We'll focus on 4 crucial sections that shape a company's financial structure. Section 41 on securities, Section 42 on private placement, Section 43 on share capital, and Section 44 on the legal nature of shares and debentures. Understanding these sections is vital for anyone aiming to lead, advise, or invest in the corporate world. We'll simplify legal jargon, use real-world examples, and show how these rules connect to create a system for raising and managing capital. By the end, you'll have a solid grasp of these core principles, empowering you to navigate corporate finance with confidence. Let's get started by defining what securities really means under the law. Transition to next scene. Section 41 adopts a broad definition of securities, covering shares, debentures, bonds, derivatives, and more, ensuring all major financial instruments fall under regulatory oversight. This means whether a company issues shares, bonds, or complex derivatives, they're all subject to the same legal standards, protecting investors and market integrity. Section 42 introduces private placement, a way for companies to raise funds from a select group, capped at 200 people per year, excluding QIBs and employee stock options. Private placement is exclusive and direct, avoiding public offers and their complexities. The process is tightly regulated. Companies must pass a special resolution, send formal offer letters, Form Pass-4, and cannot advertise or market the offer publicly. Funds from investors are kept in a separate account and used only after proper allotment and regulatory filings. These safeguards ensure transparency and protect both the company and its chosen investors. Transition to next scene. Section 43 defines 2 main types of share capital: equity and preference shares. Equity shares represent ownership and voting rights. Holders take on more risk but can gain higher rewards if the company succeeds. Preference shares offer fixed dividends and priority in repayment if the company winds up, but usually lack voting rights except in special cases. Equity shareholders are last in line for assets but have a say in company decisions. Preference shareholders get paid first but have limited control. Private companies can customize share classes if their articles allow, giving flexibility in structuring ownership. For most public companies, the distinction between equity and preference shares shapes shareholder rights and company control. Understanding these differences is key to grasping how companies balance risk, reward, and influence among investors. Transition to next scene. Section 44 gives shares and debentures the status of movable property, making them legally transferable, just like physical goods. This legal status is what allows shares to be bought, sold, and used as collateral, forming the foundation of stock markets. Ownership is recorded via share certificates or electronically in demat accounts, granting rights like dividends, voting, and a share in assets. Shares in public companies are freely traded on exchanges. Private companies may restrict transfers to maintain control. The seamless transfer of shares enabled by their classification as movable property powers the liquidity and dynamism of modern capital markets. Section 44 bridges the gap between abstract financial interests and real transferable assets. Understanding this concept is essential for anyone engaging with corporate securities. End.